In this lesson, you're going to learn how to make pro forma balance sheet adjustments in the context of a more advanced LBO model. Now, once again, this echoes something that we did in the merger model previously, where we combined the balance sheets for the buyer and seller for Apple and Research in Motion in the case of the merger model. And in this model, we just made very simple adjustments. We had this adjustment column, and we just made positive or negative signs for each of the numbers here, and then created a combined balance sheet all the way over on the right side. So in principle, many of these concepts are still going to apply, but we're going to make these adjustments in a bit of a more sophisticated way. So with cash, for example, we're still going to have to subtract cash because Apple is going to be using some of its own cash to finance the deal. We're still going to have to modify PP&E, goodwill, and intangibles. On the liability side, we're still going to have to add in debt. We will still have a deferred income tax liability to deal with. And then under shareholders' equity, we're still going to be wiping out the seller's shareholders' equity and replacing it with something else. So all those concepts are still going to apply in this case, but the way that we're actually going to make the adjustments is a bit more sophisticated and adheres more closely to standard accounting practice with balance sheets. So you see in front of you is an area called Transaction Adjustments, which has debit, credit, and then FY 2009. This FY 2009 column is really for the pro forma versions of the balance sheet. So after the LBO has taken place, how does Apple's balance sheet here actually change? Now the way this works, as you can tell by looking at some of the formulas here, if we go in and just press F2, we can see that on the asset side of the balance sheet, we add the debit and then subtract the credit to get to the pro forma version. By contrast, on the liability side of the balance sheet, what we're doing is we are subtracting the debit and then adding the credit to get to the pro forma version. Now, the exact reason for this gets into a lot of accounting details, so I'm not going to repeat all that here, but that's really the basic idea, that whenever we're adjusting the balance sheet, making adjustments to the journal entries as we are here, on the asset side, when we have a debit, that means that when the asset accounts increases, when we have a credit, that means that one of the asset accounts decreases, and vice versa on the liability side of the balance sheet. This is a bit counterintuitive because in everyday usage, the words debit and credit are used differently. So when you hear debit, normally you think that means that you're subtracting something. When you hear credit, that means you're adding something. But in accounting terms on the balance sheet, it doesn't quite work that way. And the exact treatment depends on which side of the balance sheet you're looking at. So to get started with these adjustments, remember that for cash, we are using up a small portion of Apple's cash in the course of the transaction to finance some of the deal. So on the debit side, I'm going to say 0 because we're certainly not going to be adding anything to Apple's cash here. On the credit side, I'm going to go up to our sources and uses actually. And I'm going to pull in this excess cash number from here because this is how much of Apple's existing cash we're using to finance the deal. Now for short-term securities, accounts receivable, inventory, deferred tax assets, and other current assets, I am not going to change anything here. We're going to keep these exactly the same. And that is generally what you see in LBO models. You hardly ever see any changes to these types of items. So I'm going to say 0 for all of these. One note here is that with deferred tax assets, sometimes, depending on the type of transaction, you may actually write down this balance. If you want more details on that, look at the even more advanced LBO model in the Yahoo case study. We're not going to bother with it here because we're dealing with 4 million, so it really doesn't make a difference, and because the rules get complicated to explain. But that is one added thing we could put in here. I'm ignoring it for now because we don't have to worry about it and because it's so small to begin with. So moving further down on the asset side, for long-term securities, nothing here is going to change, so we're going to enter 0. For plants, property, and equipment, remember that we have a write-up here. So I'm going to add to the debit side in this case. I'll go up to the goodwill and purchase price allocation schedule and add in this PP&E write-up amount. I'm going to say 0 for the credit side because we're certainly not going to subtract anything from PP&E. Now for goodwill, remember that what we're doing here, we are creating some goodwill, but we're also writing down the existing goodwill balance. So on the debit side, I'm going to go up to our goodwill and purchase price allocation schedule. I'm going to add in this new goodwill being created. On the credit side, I'm going to go up to that schedule and I'm going to put in the existing goodwill that's being written off. So overall here, the new goodwill number is simply equal to the goodwill that we're creating. The reason this happens, of course, is because we're writing off the existing number, so the new number comes out to exactly the new amount that we're creating. For other intangible assets, remember that we have an intangible asset right up here. So I'm going to go up to our schedule once again and pull in this 36 billion number. There will be no credit on this one because we're not subtracting anything from intangible assets. For capitalized financing fees, again, we are creating a new item here. So I'm going to add this in the debit column. I'm going to go up to our sources and uses schedule and pull the capitalized financing fees directly from here. There will be nothing on the credit side for this one because we're not going to be writing anything down. We don't have anything to begin with right here. Other assets I'm going to leave alone, so this stays at 0. We see that post-transaction, our balance sheet has changed significantly. Our assets are now 238 billion, whereas before they were 47 billion. And this really reflects mostly goodwill and intangibles being created, because what's happening here is that this transaction is telling us that Apple's market value is once again significantly different from its book value, from its shareholders' equity, and so the asset side of the balance sheet has gone up to reflect this fact. Now, moving to the liabilities. So for the revolver, we're going to enter 0 for both of these columns, because once again, we're assuming that the revolver is undrawn to begin with, so we do not have anything here. For accounts payable, accrued expenses, and deferred revenue, these are all going to be 0 as well. And that's the typical assumption. These rarely change in the context of an LBO model and the pro forma balance sheet adjustments here. Even with a merger model, these rarely change. The only possible adjustment here is with accounts payable. If you had intercompany accounts payable, so in other words, the buyer owed the seller something, the seller owed the buyer something, you might adjust for that. But in this case, our buyer is a shell company, so it doesn't really make any sense to have intercompany accounts payable. Moving on to long-term liabilities. So for deferred revenue, we're going to say 0 for both of these, and there's just no reason to change this, so we're going to keep this at 0. For existing long-term debt, once again, this does not change at all. It's 0 to begin with, so I'm going to keep it at 0. Now for the term loans, subordinated notes, PIK loans, and deferred tax liabilities. So these are all going to change, and they are going to increase in this case. If you forget which column we should be modifying, just go to this formula. We see that once again, in this case, for the liability side in the balance sheet, we subtract debits and add credits. So that's what we're going to be doing here. So for term loan A, I'm going to say 0 in the first column. Actually, I'm going to say 0 for all these columns. So all these new items, we're not subtracting anything. We are simply adding in all the new debt and the new deferred tax liability. So I'll go up to our debt assumptions to get the term loan A number. Now we'll copy down to get all the way down to the PIK loan. For the deferred tax liability, I'm going to go up to our goodwill and purchase price allocation schedule and pull in the new deferred tax liability directly from there. Other long-term liabilities, we're not going to change at all. So that's it for our liabilities. And then on the shareholders' equity side, so what we do is, once again, as with the merger model, we're going to assume that everything under shareholders' equity currently is completely wiped out in this transaction. So on the debit side, we're going to simply link in the existing numbers for all these. So common stock, additional paid-in capital, treasury stock, retained earnings, and then accumulated other comprehensive income. So all these, as you can see, are going to 0. And instead what we're going to do is we're going to replace each of these items with sponsor common equity. So I'm going to say 0 on the debit side for that one, and then on the credit side, I'm going to go up to our sources and uses schedule, and I'm going to pull in the number that we're using for investor equity here, so the 132 billion. And so now essentially the sponsor common equity number is taking the place of all these previous items on our balance sheet. I'm going to say 0 for the credit column for all these. And so now we can see that our balance sheet is almost balanced, except we're off by 53 million here. So as we saw with the videos on balancing your balance sheet all the way back in the Creating 3-Statement Models course, whenever you have a constant difference like this on your balance sheet, it means that usually something very simple is going wrong, and in all likelihood a constant number is off in the first year here. In this case, it's fairly obvious that what we've done is we've forgotten to take into account one of our transaction adjustments. The first thing I like to do here is to go back up to our assumptions and see if anything jumps out at us. So under the debt assumptions, we know we have all these tranches of debt taken into account, and these are huge anyway, so it wouldn't be one of these. The revolver we don't have because we're not drawing on it. Moving down to sources and uses, so we know we have excess cash taken into account on the balance sheet, we have all the debt, and then we have investor equity being taken into account. The equity value of the company is not directly being taken into account, but we do have it. We are factoring it in because of our goodwill schedule right here. So we are factoring in this difference and the fact that the shareholders' equity goes away. Similarly, capitalized financing fees are also being taken into account because we have a new item on our balance sheet. But what's missing here are the advisory fees and then the legal and miscellaneous fees. The reason they're missing, if you look at it and think about it, is because they're not present in our goodwill schedule anywhere. So they're not anywhere here, but then we're also not creating new items on our balance sheet for these. Also, if you look at the numerical values here, 43 plus 10 is 53 million. So that tells us that it's clearly these two numbers that we have not yet taken into account. Now remember that these happen immediately at the moment of a transaction, and so we like to expense them in this transaction rather than putting them on the balance sheet and amortizing them over time. The standard practice for expensing these is to go down to the balance sheet and go down to retained earnings under shareholders' equity and simply add them to our debit column right here. So what we're doing is essentially adding them as another debit, and we're subtracting them from the company's existing retained earnings. This will create a negative retained earnings balance for the first year, but that's okay in this context. This is actually very standard to do with LBO models like this. So we're going to go up to our schedules and simply pull in the advisory fees and then the legal and miscellaneous fees as well. So now we see we have a negative retained earnings balance in the pro forma 2009, which is fine. This actually happens very frequently with LBO models, and it doesn't mean anything in particular. All it means is it's being wiped out, and we're expensing some of the transaction fees to this retained earnings account. And now we see that, as expected, our balance sheet now correctly balances. It's 238 billion on the liabilities and shareholders' equity side, and also on the asset side. And it's also balanced in all future years as well. So we're not completely done yet. We'll have to make some further adjustments to this to take into account the debt and some of the other items, but we have made progress, and we now have our pro forma balance sheet adjustments for this transaction. As you can see, it's not dramatically different from what we did in the merger model, but the way we're making these adjustments with the debit and credit columns here is more sophisticated, and it's more in line with what accountants do and what you see as the standard in models used at banks and private equity firms. So with all this in place, in the next segment of this course, we're going to be getting into our debt schedules. And we'll see how the debt schedules have a lot in common with the more basic version that we looked at in the basic LBO model, but we're going to go significantly beyond that, and we're actually going to split those videos into 3 parts in this course. So we're going to have 3 different videos on debt schedules and interest calculations, because it does get significantly more complicated when you have multiple tranches of debt as we do here.